Hello and welcome back. You are listening to Earnings Unscripted, where we unpack what really happened in today's earnings without the corporate PR filter. I'm Susie, here with Miro. It is Tuesday, January 27th, 2026, and today we are looking at General Motors. Miro, I was reading through this release, and honestly, it feels like they just decided to clean out the entire attic in one afternoon. Messy, expensive, but maybe necessary?
Messy is polite. This was a textbook kitchen sink quarter. You look at the headline net loss, $3.3 billion. Just a massive swing into the red compared to the $1.3 billion profit they posted in Q3. But then you look at the stock price. It opened strong, held the gains, and closed up about 3.3% at $86.38. So clearly the market saw the blood on the floor and decided it was therapeutic.
Therapeutic bloodletting. Only on Wall Street. But okay, let's ground this for a second before we get into the psychology of it. Give us the actual numbers, because that net loss is ugly, but the adjusted stuff seemed fine.
Yeah, the underlying engine is still running. Revenue came in at $45.3 billion. That is down about 6.8% from last quarter, mostly on lower volume and mix. But the big noise is in the earnings per share. On a GAAP basis, they lost $3.60 a share. However, if you strip out the special items, and trust me, there were a lot of them, adjusted EPS was $2.51. That is down from $2.96 last quarter, but it's clean.
$2.51 adjusted versus a $3.60 loss. That is a wider gap than usual. So basically, they took a bunch of massive charges this quarter to make the future look prettier.
Precisely. They booked $7.2 billion in special charges. Most of that is non-cash write-downs. They're basically admitting, hey, remember those EV plans we had, specifically the Orion plant and the BrightDrop vans? Yeah, we were too optimistic. We're writing it off.
Right. The realignment, which is corporate speak for oops. And just a quick side note for everyone listening. Obviously, we're just two people reading reports here. None of this is financial advice, just our personal opinions. Don't trade based on our banter.
Please don't. But Susie, here is the thing that's interesting. Usually when a company announces a $3 billion net loss, the stock tanks. Here, it gapped up. Why? Because they paired the bad news with a candy bar. They authorized a new $6 billion buyback and hiked the dividend. It's like saying, sorry, we lost money on paper. Here's some cash to keep you quiet.
It's the look over here strategy. Don't look at the write down, look at the buyback. But honestly, Miro, isn't there something refreshing about it? They're finally admitting the EV transition was, let's say, clunky.
It is refreshing. It's honest. And look, cash flow was flat at $5.6 billion. The business is still printing money. But there is one red flag we can't ignore in the opening: China.
Oh, yeah, that number jumped out at me, too. They used to print money there. Now?
Now it's an anchor. Equity income from China swung to a loss of $513 million. $500 million gone. That used to be their cash cow. Now they are restructuring just to stop the bleeding.
It feels like the end of an era, doesn't it? So we've got a massive domestic cleanup, a buyback to soothe the investors, and a crisis unfolding in China. It feels like a pivot point. All right, let's get into the details of that $7 billion charge, because I feel like that tells us everything about where they think the industry is actually going.
Yeah, it's not just accounting. It's a confession. Let's dig in. Short pause.
So, hold on. Confession is a pretty heavy word for a corporate earnings print, Miro. You're saying that by writing off $7 billion, they're basically admitting they got the timeline wrong.
Worse, they're admitting the math didn't work. Look, Most of that $7.2 billion is non-cash. It's asset impairment. They looked at the machinery for the BrightDrop vans, they looked at the tooling for the Orion plant, and they realized those assets weren't going to generate the returns they promised. So poof, they wiped them off the books.
Which hurts the net income number today, obviously.
It destroys net income today. But, and here's the cynical brilliance of it, it helps margins tomorrow. Because if you write down the asset now, you don't have to depreciate it next year. You lower your future expenses instantly. It's like burning your furniture so you don't have to pay to move it.
Burning the furniture to save on movers. I love that. But it's also a little terrifying if you're an employee at the Orion plant, right? It feels like they're clearing the decks of the whole EV hype phase.
They are. They're pivoting from growth at any cost to profitable at any volume. But, Susie, while everyone is staring at the EV wreckage, there is something else buried in the transcript that I think is actually more important for the long term. Did you catch the note about the industrial bank?
The industrial bank? No, I must have glazed over that part. That sounds incredibly 19th century. The General Motors Industrial Bank and Trust.
It sounds boring, which is why it's genius. GM Financial finally got conditional approval for an industrial bank charter. That means they can start accepting deposits, high-yield savings accounts, CDs, that sort of thing.
So, wait. So I can open a savings account with GM?
Exactly. And why does that matter? Because right now, to fund car loans, they have to borrow money in the debt markets, corporate bonds, securitizations. That's expensive. But if they hold deposits, that is cheap, sticky capital. It lowers their cost of funds significantly.
Oh, I see. So instead of paying Wall Street 6% to borrow money to lend to a truck buyer, they pay me 4% on my savings account. They keep the spread.
Bingo! It widens the moat. It turns their finance arm, which is already a beast, by the way, into a legitimate deposit-funded bank. It makes them less reliant on the whims of the bond market. It's a structural advantage that Tesla doesn't have that like this. Ford doesn't have it like this.
That is actually fascinating. It's like they're quietly building a fortress while everyone else is arguing about battery chemistry.
Right? It's boring, it's unsexy, and it's gonna print money. That's the real GM strategy. Right now, retreat from the flashy stuff that loses cash and double down on the boring stuff that builds leverage.
So they clean up the balance sheet with the write-down, and they lock in cheaper funding with the bank charter. That's a powerful combination, but it brings us back to the big question.
Which is,
if the machine is tuned this well, where is it actually going? Because they gave us some guidance for 2026, and frankly, I'm trying to figure out if it's realistic or if we're just setting up for another realignment next year.
Yeah, the guidance, yeah. Let's step back for a second and look at what they're actually promising because there are some ghosts in those numbers.
So the headline guidance is 13 to 15 billion in adjusted EBIT, which is robust. It's basically flat to slightly up from this year.
Which, considering the chaos, sounds like a win.
It does. Until you look at how they plan to get there, they've baked in a projected $1 billion benefit from lower warranty costs. That means they are betting heavily that they won't have another massive recall like the V8 issue or the Tahoe software glitches.
Oh, so they're counting their chickens before the cars are even driven.
Exactly. And then you have the tariff elephant in the room. They're projecting $3 to $4 billion in gross tariff costs next year. They claim they can offset a lot of it with efficiency and pricing, but that's a very steep hill to climb.
So zooming out then, what's the real story here for the next year? It feels like they're shrinking the dream to save the dividend.
That's the perfect way to put it. They are transitioning from a growth tech narrative back to a high-yield industrial narrative. They're saying, look, we might not be Tesla, but we will buy back $6 billion of stock and pay you a fat dividend while we figure it out.
And honestly, investors seem okay with that. The stock is up because certainty, even boring certainty, beats expensive promises.
In this rate environment, absolutely. Cash today is worth way more than a robot taxi in 2035.
Fair point. So what are you watching for Q1?
North American margins. They want to get back to 8 to 10%. If the tariffs hit early and they miss that margin target, this relief rally could evaporate pretty fast.
And I'll be watching China. If that $500 million loss gets any bigger, the restructuring might turn into an exit strategy.
Let's hope not, but it's definitely on the table.
All right. A messy quarter, a brave cleanup, and a lot of promises on execution. If you're listening, hopefully that clears up why the stock went up, even though the ink was red.
Just don't forget to check the warranty line next time.
Always the optimist. Thanks for hanging out with us. Actually, before we cut the feed, I want to take a quick second to pull back the curtain on what you've just been listening to. Because Earnings Unscripted isn't just a podcast about finance, it's an experiment.
A pretty ambitious one.
Right. We are a small team of enthusiasts exploring the frontier of what artificial intelligence can actually do. Every part of this episode, from the research analyst digging through the 10K, to the scriptwriter crafting our dialogue, to the voices you're hearing right now, was generated by a team of AI agents working together.
Even the skepticism was algorithmic, though I like to think the personality is real.
It feels real to me. And that's the goal, to see if machines and humans can collaborate to deliver high-quality, factual information that feels, well, human. We have a QA specialist checking the facts, but the delivery is all us.
If you have thoughts, feedback, or just want to know how the sausage is made, we'd actually love to hear from you.
You can reach the team at earningsunscripted@datamadness.ca or follow the project on X. We're just getting started, and we're learning as we go. Thanks for trusting us with your time today.
See you after the next call.